All righty, Steve. Thank you for joining us for the third episode. Really excited on this one. We started off with oil and gas, oil, and then we did a natural gas producer, and now we're making our way to OFS, to a fracking company. So we're really happy and thankful for having you join us here today. We've got kind of a list of material here to discuss with you. And I wanted to start off with a brief introduction for the audience, a little bit about you and how you got involved in the business, maybe even education, and kind of allow maybe the audience to familiarize themselves with you a little bit. And then we're going to move over to a discussion about STEP. And then that will segue us into the rest of the conversation. And hopefully by the time we're done, everyone's going to get a chance to get a little more insight into the OFS space. So I'll pass it over to you, Steve.
Oh, thanks, Sohab, and appreciate the opportunity not only to talk a little bit about myself, but about the company STEP Energy Services. So I'm the president and CEO. I've been in the industry for over 30 years. I grew up actually on a family farm in northern Saskatchewan, and at the young age of 18, my dad said there's not enough income for two of us on this farm, so you need to get out and get an education. So I went to Calgary as started in the petroleum engineering technology discipline out of SAIT. So I'm a SAIT grad. When I graduated in 1992, the price of oil was $12. So it was pretty tough to find a job, but I was able to get a job with a company called Schlumberger, which of course is Schlumberger now, or SLB. And so I cut my teeth actually on the OFS space right off the very beginning of my career. And I was on a primary cementing crew where we were cementing casing on drilling rigs, and then I spent 10 years with that company, primarily in Canada. Did a little bit in the US, but focused a lot on obviously pressure pumping and some coiled tubing work. And my claim to fame that I'm very proud of is I was on the very first coiled tubing frac in the world, and that was in 1997 in southern Alberta. So anyways, fast forward to today. I'm one of the co-founders of our company, STEP Energy Services. We started in 2011 with some private equity money that we were able to gather up through ARC Financial. They're still obviously a major shareholder today that hold 57% of the company. The thesis behind getting the company started was we wanted to get into deep capacity coiled tubing. And if you back up 12 years ago, extremely buoyant business in the industry in Canada. A lot of capital investment was going into pressure pumping, but as the wells were getting deeper and deeper, the coiled tubing capacity that was available in the market at that time wasn't deep enough. And so we were able to get funded by ARC Financial to get our business kicked off by building deep capacity and reliable coiled tubing. And so we were able to kind of build that company, or the start of the company, out till 2014. The downturn hit. We had 12 active deep capacity coiled tubing units, focusing primarily in the Montney and the Duvernay. And of course, when the downturn hit, we had some options of what we wanted to do. Our balance sheet was very strong at the time, and so we decided to look for a management team in the U.S. as we saw the U.S. as a bigger market than Canada. So we were able to move some of our assets into the U.S. Found a great management team in 2015, and at the same time we took advantage of an opportunity, a business transaction where allowed us to get into the pressure pumping space by buying a company called Calfrac out of CCAA, so bankruptcy protection. That really got us a very, very modern fleet of assets, lightly used at basically kind of 25 cents on the dollar. And so we were building out our frac business, and then another opportunity came up, which was Sanjel. Sanjel, of course, was a private company in North America. They ended up going through a similar process of going into bankruptcy. So we were able to purchase the pressure pumping and coiled tubing side of their business in 2015. And allowed us to get a very, very large, footprint in Canada, where we were really the second largest with the consolidation that we did. So we're operating kind of 250 to 300,000 horsepower in Canada. And in 2017 we decided to IPO the company. It was very difficult even back then of trying to. I think we were the last energy services company to actually go public. And so we were successful in getting that across the finish line. We thought we were kind of out of the downturn, and we took advantage of buying a company in the US called Tucker Energy Services in 2018. We kind of loaded up our balance sheet at the time, thinking that with the free cash flow that we could generate out of the business, we'd be able to correct that. And of course, everyone remembers 2019 wasn't great in this industry, and then of course COVID hit. So we had about, call it 1,500 employees kind of pre-COVID. We actually scaled the operation down to about 475 going through COVID. And I'm happy to announce today we're kind of back to pre-COVID levels, and excited to come off a wonderful year that we had as a company in 2022, where we generated top line revenue of close to $1 billion, and then EBITDA of about 200 million. So if you kind of rewind the clocks, in 2020 we generated about 30 million of EBITDA with the same asset base. 2021 we generated 60 million, and then of course 2022 we generated 200 million. So it just shows the torque that's in this business today. So so we celebrated our 12th year of in business, Soab, and I would say that we're in great shape from a balance sheet perspective. And this industry, of course, is not for the weak. And as we've seen lots of ups and downs, we were probably one of the best OFS performing public stocks in Canada in 2022. And then, of course, oil prices were $120 and $7, $8 gas, and everyone was happy. And now we sit today with WTI prices still at a healthy level at $75, but gas has been taking a little bit of a negative turn, but I think that's short-lived. That's our perspective anyways.
So Steve, what's putting yourself in the mind of an E&P investor that's considering OFS? It's the style is different, the metrics used is a little bit different. What's a good way of with the E&Ps, you look at it, you're like, okay, well, this is the price of oil, this is their break even, this is their well economics, and you're able to kind of anticipate how it's going to be able to look like. We did a primer with Chris in Canada in the Spaces earlier today, and kind of getting maybe his understanding as an ambassador of the OFS space on his end.
Right.
How do you do it, Chris? How do you kind of keep on track or trying to stay ahead of these types of trends? So I'll pass it over to you, Steve, and you can help with maybe give an insight as to how to look at it, how to stay on top of your names. How do you kind of navigate in a space that's more requires more perspective, you to be able to go beyond maybe the presentation on the website to be able to get a kind of a fuller and better picture?
Yeah, no, I appreciate that, Sohab. So just maybe to clarify a little bit before I get into answering that question, just want to clarify that we operate both in Canada and the US. We have 490,000 horsepower of frac capacity, and that's basically positioned. We have 5 deep capacity or deep kind of crews in Canada that focus really on the Montney and Duvernay, assets in Canada. And then we have, a crew that focuses a little bit on the Viking, so shallower oil, and even into Manitoba and the Bakken and Saskatchewan. So, and then when we look in our U.S. business, we have three really, dedicated or fleets in the Permian Basin. We believe that's the area that we want to focus on. It's oily rich. Of course, we haven't seen much of a pullback from a drilling rig count. In fact, it's probably increased a little bit compared to other areas, but just wanted to set that stage. And then, of course, from a coiled tubing perspective, we'd be considered the largest deep capacity coiled tubing player in North America, where we have currently today we have 21 active units across Canada and the U.S. 9 are in Canada, and 11 are in the U.S. And we have the ability to go to 33 altogether. That's kind of our fleet size. So we have lots of opportunity to add more equipment to the field on the coiled tubing side if we see the market kind of requiring that. But to answer your question in regards to how do we plan our business around E&P activity and how from an investor standpoint, what would make OFS more attractive than E&P, and I can answer it a couple of ways, but I've seen over the last, I'll say a decade, because really that's kind of what we're looking at right now. The last 10 years, there's been a lot of consolidation that's happened, both on the pressure pumping side and on the coiled tubing side. Hasn't been a lot of startups. When you look at the U.S., there's 290 frac crews that are operating in the U.S. today. In Canada, there's about 30. So call it we're 10th the size. But in the U.S., 60% of that market is held by 4 companies. Halliburton, of course, is one. Next here, then you have Liberty and ProFrac. And ProFrac has been a company that's been buying up, consolidating the market quite well. So when you think about that, you have 4 very, very large companies that are really controlling the market from a pricing standpoint. They've been extremely disciplined on not reactivating equipment to flood the market. They understand that that shareholders need returns, so they've been focusing on margins in their business, which of course helps everyone else. So what gets us quite a bit excited in our space is that this asset base doesn't last forever. When you look at a pump itself, that each fleet in the Montney requires about 50,000 horsepower, or call it 16 to 18 pumps on location at each time, and these pumps are made up of major components such as engines, transmissions, and the pump itself. And we're putting on typically between 3,000 and 4,000 hours per year. And so when you have an engine that lasts about 20,000 hours, you go through what's called a refurb cycle. And the newest frac crew to come to Canada was actually in 2016 by a company called Canyon. So that was when you look at it, there hasn't been a lot of capital investment put into the OFS space over the last 5-6 years. So what we're seeing is more refurbishment, getting newer engines put on older assets. And in our IR deck, I think it's slide 15, we talk about how we've been able to match our capex to depreciation, and that's something that we've been focused on as a company. Is we want to make sure we have the most relevant fleet that's active, and really have not stopped spending money on keeping a relevant asset base even through the downturn. We've been obviously wanting to see better times, and we saw it in 2022, and we had an asset base that really functioned extremely well, and we're going to continue to do that. So hopefully I answered your question. I do see from an E&P perspective, they obviously they have a depleting asset base, right? So they drill wells, they have X amount of acreage, and of course we help in developing that. We need to bring the latest technology to their locations to be able to provide I would say adequate and efficient operations to make sure that they get a return so that we can get a return as well. And that's been from a lack of capital that's been invested in the industry, it's nice to be able to see us both sharing in some wins from a profit perspective.
And Steve, that maybe takes me to another point, which is looking at and saying, okay, you mentioned the different service lines. For if you can just talk a little bit about those service lines and talked about, what does this do and what does this do? Get into a little bit of detail of that, I think will allow the audience that maybe is not familiar with OFS to understand what that's all about. So if we can just kind of rewind and just go a little bit deeper into the
Sure.
service lines. You mentioned the fracking, the coiled tubing.
Yeah, so we're primarily on the upstream side of the business. So we show up after the well's been drilled. So it hasn't been produced yet. So the well is drilled, it's cased, it's cemented. We will show up on location with our pressure pumping equipment. Majority of the time today, they're on multi-well pads. So a pad location can consist from 2 wells up to, we've been on jobs that have been 18 wells on a pad. And so our equipment will show up, and what we do is we will, there'll be basically a perforating company come in there and basically shoot holes in the casing. They start at the very toe of the well, and then they work along the horizontal, and we'll put basically fracs in certain intervals, upwards of, call it 50 stages in a well, that we'll put we'll place proppant or sand into each stage, and then each stage is usually isolated by what's called a bridge plug. And a bridge plug is there basically as a zonal isolation device, and then we'll carry up the horizontal well till we get really to the heel of the well. Once that is completed, then our coiled tubing business, of course, comes in after the frac equipment is rigged off. And our coiled tubing business goes in and consider it like a roto-rooter of, we're the plumbing experts of these wells. And we have the ability to go in and basically run a bottom hole assembly with a mill on the end of coiled tubing. And we'll go in and mill out all these bridge plugs and clean the well out, and we'll get it flowing. So that's what we specialize in. If you look at the wells, they're getting deeper and deeper, particularly in the Permian, where we start seeing a lot of the tier 1 acreage being drilled up. So we see a lot of operators going to, their tier 2 acreage, but in order to get the equivalent production out of, kind of a weaker zone that have been drilled up or under, depleted, they drill it longer and they put more stages in. So it's extremely service intensive. And we went through an acquisition in September last year where we bought the coiled tubing assets from ProPetro, which is, of course, is a publicly traded company called Pump, is on their New York Stock Exchange. And we bought their coiled tubing assets because they were very niche. They were ultra capacity. So they were able to haul 30,000 feet or close to 9,000 meters of coiled tubing onto one reel. It's a continuous string of pipe. So we don't have to, the advantage with coiled tubing is you don't have to make connections up like you would on a service rig or a drilling rig. So you have that ability to work under pressure so you can keep the well flowing all the time. And it's extremely efficient, as you can imagine. You're not making connections. So that's the advantage that we have with our business.
And correct me if I'm wrong, Steve, but the way I see it is, with an E&P, your success is going to be predicated based on the cost of extraction as opposed to your cost that you're able to sell it for. And that's going to dictate how successful you're going to be in that business. Whereas my understanding is the success of the OFS business is going to be predicated based on the quality of your equipment and the quality of your people. The quality of your equipment to be able to do to operate at a much more efficient rate, and your people to be able to know how to manage it. So having said that, would you be able to speak a little bit about STEP's a competitive edge, or what you feel allows STEP to stand out to maybe some of the other OFS companies?
Yeah, I mean, you talk about labor and our people. We call them we don't call our people employees, we call them professionals. And we've done that from the very beginning of the onset of the company. Just, you know, it brings a sense of pride, I guess. And if you act like a professional, if you call a professional, you're going to act like a professional. And so I believe that we have the best, you know, people in this industry that are trained. We have a very large training center in Red Deer. You know, just to talk a little bit about our training center, we have a lot of, you know, class 1 drivers or CDL drivers, and STEP is really one of the only third-party companies other than Alberta government to offer a class 1 driving school. So we offer that in-house. So that's a competitive advantage for us. We do it to the Alberta standards, and we've graduated about 260 drivers out of our program since 2018. So it's a big competitive edge. And one of the things that I don't think most people are aware of, we have one of the largest or the largest logistics teams in Canada. And so we haul 80% of our own proppant. So just to kind of put that in context, we hit a record last week on the amount of sand placed in a 24-hour period on one well. So one well in a 24-hour period, we pumped 5,200 ton of proppant. Take a guess how many trucks that is, Soab. 5,200 ton.
5,200 tons.
Yeah. Anyways, it was 130 B train loads of sand being brought to location. And so we did that in a 24-hour period. So that is something that we've designed within our company to control the last mile, basically called last mile solutions, taking proppant that has been delivered from Wisconsin, it's railed all the way up into northern Alberta into a transload facilities, and at that point we have full control over that sand getting to and from our client's location. So it protects us from cost inflation on the trucking side. It also allows us to really move proppant to different areas to be able to be strategically focused on getting the clients the sand that they need. And also the third major thing is, you know, you talk about profitability. It's to us, it's about our asset base. Our pressure pumpers need to be pumping all the time. You know, so we control the whole supply chain to make sure that our frac crews are pumping 20 to 22 hours per day. And that's a huge advantage that we have compared to our competitors.
So that is interesting. So you mentioned that you got a sort of a logistics. So is it typically in the OFS world, some of them wouldn't have their own logistics in-house, so someone else, you know, you would have your own provider that would tend to you. Is that generally how it works?
That's generally how it works. That's right. Yeah. I mean, there's only a few of us that provide that service, complete bundled service. And we would have the largest in Canada of doing that.
And, you know, when we talk about, you know, barriers to entry in the space and say, okay, well, that's maybe another concern that people may have. Okay, well, the competition could be immense. Other people can get in if it's profitable, bring equipment that may be sitting on the fence and take us back. Now we see the day rates, you know, making their way up, but the threat of somebody coming in and kind of forcing its way down. We can maybe talk about the strength of that moat, so to speak.
Yeah, there hasn't been, if you look at Canada, I'll just focus on Canada itself. There hasn't been any new entry into the pressure pumping space really since, call it 2015 when we started. And we bought assets at a liquidated value. So if you were to look at getting into the space today, let's say I wanted to start up my own pressure pumping company. Get into a new purchase price today, you're about $1,000 a horsepower. So to get one frac crew, if you wanted to play in the Montney, you're call it $50 to $60 million. That's just for the asset base. Then you obviously have facility cost, you know, then you have like not only infrastructure costs, you have to have sand storage. So it's a big money game right now. And you know, so and if you're only going to do it with one crew, it's not very profitable. So, you know, you need scale in this business today. That's really what drives your margin is scale and high utilization. And I've been on record. I've been at a number of conferences where I debate with some of our competitors about assets, you know, bringing fleets off the fence. And there's not a lot of fleets available, by the way, that you know, they're on the fence for a reason. You just can't. I call it the trim clad tune-up. You just can't put paint on it and put it to work. They require extensive capital to get it back in the field, and frankly, we don't need it. The Canadian market doesn't need any more, you know, capacity. What we need is utilization, and we proved that in Q2 last year, where our utilization in Canada, we basically had higher utilization in Q2 than we did Q1. And of course, Q2 is considered our spring breakup period. But as these operators have been able to work on these multi-well pads, and be able to you know, kind of forward-looking, designing their pads close to highways, so you don't have to worry about roads falling apart. I see that being a norm in our industry, and I think it's great for from a Canadian perspective, because we have now call it 11-month cycle versus a 9-month cycle that we used to try to make profits on. And you know, we're starting to see our Q2, of course, turning up to be a very profitable quarter.
So if you can just break that down a little bit. So you mentioned, okay, so if you could talk normally how it works, Q1, Q2, Q3, Q4, and then talk about how OFSs operate within those cycles a little bit. So, you know, Q1, Q2, and onwards for the ones unfamiliar with.
Yeah, historically, you would have seen the highest drilling rig count in Q1, and we still see that today. Where I mean, we hit in the WCSB, we hit, I think it was in late January, early February, we had 250 drilling rigs, which is you know, since 2018 we haven't hit those numbers. So extremely excited to see, you know, the drilling rigs go back to work. You know, for our business, we had a great Q1, but that carries over into Q2 now, where in the past it would be, you know, kind of shut down, send everybody home for 6-7 weeks after all the equipment gets kind of fixed up from Q1, and then bring them back and then get ready for, you know, kind of Q3 and Q4. Now it's been more consistent. We actually, you know, we see Q2 being extremely highly utilized in Canada. And I think that's what this industry is required to be, is efficient, to be able to keep our costs down, is to work 11-month cycle versus a 9-month cycle. And you know, back to my point is, that's where I think you need, you know, our competitors saying the same thing versus adding more equipment into the basin for like a Q1 period. You just can't find the people. The labor is extremely tight. And so to stretch out your you know, your revenue generating years on 11 months versus on 9 months, and I think that should be the norm going forward.
And so so if I got this right, so typically the drilling happens in Q1, and when does, so you're part of the completions, is my understanding, is that right? So
yes.
So if the drilling happens at Q1, what typically would take place in Q2? That, you know, those 3 months.
Yeah, so just to be clear, like a lot of the the peak of the market is typically Q1, but the drilling rigs are still moving, you know, into Q2 when they can. But with the roads being soft and having, you know, road bans, it's very difficult at times to move this equipment. So the operators have kind of planned a lot of their leases with the directional drilling technology to be able to go out, you know, 3 kilometers sideways. They can plan their well pad locations strategically, so you can get to it through breakup periods. So call it April through June is our breakup period. And so there'll be, obviously today the rig counts at I think 100 drilling rigs working in the basin today. versus the peak of 250 in at the end of January. So, and what's really interesting is I was just in a meeting this morning, and we kind of dissect every drilling rig and where it's working, and not every drilling rig requires our services, our pressure pumping services, because some of it is in heavy oil, of course, SAGD operations, and they don't require pressure pumping there. But out of the 100 drilling rigs that are working today, about 70 are requiring completion activity. And so, yeah, so we see that as being positive, particularly in the Montney, as we've seen, you know, larger pads being developed there, which in return is more efficient for our business.
And Steve, I think one thing that maybe there was maybe a surprise by, for me at least, is that we kind of expected, with maybe the softness of the commodity prices, both oil and natural gas, we were going to be a little bit, maybe see a slower activity. And part of the information that's coming now from Precision Drilling, Halliburton, they're seeing a lot of strength. Especially from Precision Drilling, we're seeing a lot of strength in the Canadian market. Could we maybe talk a little bit about that? You guys said that you've had a historic quarter. You've seen great demand in the Canadian market. It's just the US demand that's just, there's been a little bit of softness. Could you maybe speak a little bit as to, you know, what we're seeing right now? I think maybe a lot of the investors that were kind of looking at it and kind of anticipating that there was going to be an exaggerated sense of softness haven't seen that, and quite in fact we're currently seeing the opposite.
Yeah, I would have thought to see a little bit more capex being pulled back. But in Canada we've seen kind of the exact opposite, and I think the thesis behind that is, you know, we work for some you know, some clients that are kind of dry gas focused, but they have acreages that have liquids, and so they're kind of moving capex around to more of their liquid rich assets. I'll give you an example, like Whitecap. You know, they're going to complete some of their Duvernay wells, and that was you know, Grant was on record talking about that as moving some capex around. Birch Cliff is another one where they've kind of delayed some of the capex, but they are moving forward with doing it in Q3 and some of their wells in Q3. But I honestly think the catalyst behind a lot of the activity is because of the Blueberry River First Nations agreement that's put behind us. We're seeing, you know, more and more permits being issued in BC. There really hasn't been a lot of drilling going on there right now, and we're seeing some activity. More rigs are, you know, in fact, you talked about PD, Precision, they're moving some rigs up from the US into Canada because they do see a bit more of a robust back half of the year into 2023, where, you know, the opportunity that Canada has from an LNG front is it's going to happen within the next couple of years. And it's funny because in 2011 we built our company really around servicing an LNG market, and it's taken that long to actually see it develop. And you know, so when we have the Coastal GasLink being 80% complete today, going to be 100% done by the end of this year. You know, LNG Canada, of course, you know, first trains exporting kind of Q1 of 2025. There needs to be that inventory kind of built up for that time period. So we're going to see some more robust activity in Canada, and let's face it, any gas molecule that's required to get out of the ground today is it requires our pressure pumping services. So it's extremely intensive from an OFS perspective, and I do believe Canada is pretty exciting as we look at, you know, not only LNG Canada but wood fiber and cedar LNG. There's a number of great opportunities in front of us. So, I mean, in fact, when you look at it from an economic standpoint, they're pulling LNG out of the Gulf, and it's taken 20 days to get over to Asia. we can get it there in 10 days from Kitimat. So it just makes economic sense that it comes from Canada.
And we get the natural cold weather is for free, right?
That's exactly right. Yeah, it's cheaper to produce, to liquefy it.
Yeah. And so the other thing is, so as we were seeing this, as we we're seeing, back a couple of years ago, we were kind of seeing equipment making its way south of the border. Just the environment wasn't looking so well in Canada. Now we're starting to see maybe early indications of the opposite. Do you see maybe this as maybe something sustained to the point where I know a step is always like the optionality of being able to have an American market and a Canadian market. But if we kind of see these catalysts come together, do we see that like a bifurcation where we feel like maybe the Canadian market may, for the years ahead, really stick out for STEP as opposed to the US?
Well, we like both markets. So I mean, we proved that in kind of Q4 last year, where Canada was a bit weaker because we had some budget exhaustion happen with some of our clients in Q4, and and our US business picked up. So we were able to really balance from an overall company standpoint. It gives us the flexibility to move assets back and forth to regions that are more active. And we put out guidance 3 weeks ago about a bit softer Q1 in the US, and Canada was probably our best quarter that we've had. So I do see Canada. I just, in general, I guess I see a more stable outlook for OFS because you have long-term LNG contracts. In the US alone, there's 6 BCF a day of new export capacity that's being built right now over the next 2 years. In Canada, we have 3 BCF per day with the 3 plants that I talked about. So those are big investment decisions that go on for multi-decades. And so when you look at that compared to what we just went through, it's a complete shift of how commodity prices kind of end up driving activity, because I think what we're going to see is more consistent activity with those operations.
And Steve, one of the things when it started to kind of become clear that there was going to be a pullback in activity in the US, we've seen a reaction of the stock. And then I was looking at it and preparing for this, and I'm like, okay, the revenue was around 115 million for the quarter. The RBC forecast was 117 million. The EBITDA forecast was 26 million. The actual was 24 million. So it was just not as just a slight miss as opposed to maybe the reaction. So do you think, what do you think is maybe being misunderstood, or just any clarity in that regards? Because the result is disconnected from the reaction that we've seen. So perhaps maybe investors or whoever may be were kind of anticipating a worser environment than it would be forward.
I think you're exactly right. I think investors are just a bit nervous on everything being, drilling rigs being parked and just another cycle of a downturn. But we don't see that. We're continue to see, like, we've had a busier RFP season in Q2 than we ever have seen. So in Canada and in the US, I think the super majors or the majors in Canada, like Petronas, who's obviously needs to start drilling, they're increasing their program. ConocoPhillips is increasing their program in Canada. Repsol, a company that hasn't really done anything in quite a few years, is going to be active in the back half of this year. Shell, of course, haven't done a whole bunch in the last 2 or 3 years. They've indicated they're going to drill about 25 to 30 wells this year and into next year. So when you add all that up, there's just not enough equipment to be able to really service, or it's going to be we believe a tight market kind of leading into the back half of this year and into Q1 of 2024. I think it's going to look pretty exciting.
And I think just a note here from Andrew from Raymond James. He kind of mentioned the expectations was between it's currently priced as if the expectations about 85 to 100 million, when there's no even any indications that we are online for that type of revenue at all. So maybe just to speak of like how you think maybe the year is, like what if you can share your thoughts as to how you think the year is going to be, because that seems to be, it's a much exaggerated bearish outlook than what we're currently even seeing right now, and as we're hitting reporting season for the OFS companies.
Yeah, I mean, I will just send a kudos to Andrew Bradford. He's one of the best analysts in the business. He's been in it for a number of years, and I thoroughly enjoy reading his material, and he's usually spot on. And yeah, we're trading at a discount today, and he says it right, between kind of 80 to 85 to 110 million EBITDA. We did 200 last year, and what we're seeing currently today is that it's going to be a similar year than what we did last year. I think consensus has us at about 195, and I don't. There's no indications today that we should deviate from that, and it's hard to predict the future, and I don't want to be on record telling you that we're going to hit 190 to 200 million of EBITDA, but our asset base has done it in the past, and I think if WTI settles out, even goes to $80-85 by the end of this year, and some people are predicting $100, and then that's going to create more activity. But we haven't seen any pullback in any of our clients' capital in Canada, and in the US. We're seeing, obviously we're focused in the oiler basins in the Permian, and rig counts haven't dropped there much.
Yeah, that's part of where sort of maybe my excitement for the OFS is kind of coming from, is just kind of seeing that, being like, oh, well, this really seems like a little bit of an overreaction, especially that now we're a little bit past it and we're currently seeing where we're currently at. So my just thought process is, the anticipation is the second half is where you're really going to be able to get higher commodity prices. So if this is how we're looking, currently, then you can just imagine how much tighter it's going to anticipate as E&Ps start to bring some of their higher break-even assets once they achieve a higher commodity price. So I just kind of found that as interesting. But we'll just switch over to on your slides. I was looking at dynamic gas blending. I was looking at the tier 4 frac fleets. If we could just maybe discuss the significance of these. When I was kind of looking at them, I was kind of focused on the cost savings, but I think there's just much more other impacts that come from them, which is why you guys are moving towards it. Maybe if we can be able to fully appreciate the color and the value that being able to switch to natural gas provide, aside from just the cost savings.
Yeah, so I'll just start by explaining there's really 3 engine types that are out there today. Tier 1 engines were kind of produced in the kind of the 1990s to the kind of 2000 time frame, or somewhere like that, 2005 even. And then they're all EPA rated engines. So you get a tier 1 engine, which basically is the dirtiest kind of producing carbon engine. Then you have a tier 2 engine that is that came out in kind of mid kind of 2005 to really 2015-16 time frame. And then the tier 4 engine came in around that 2016-17 time frame, which of course is a kind of a reduces of a greenhouse gases. And then when when you couple that with what we call DGB, which is it's really Caterpillar is one of the largest, or they hold the market share really in frac horsepower engines, and they're what DGB stands for is dynamic gas blending. And so you put basically a kit onto these engines. You can do it with tier 2 and tier 4, and it gives you a diesel substitution. So you can run natural gas with the engine. And tier 2, you can get we're getting about 60% substitution percentage from diesel displacement. And then the newer tier 4 engines, you're getting up to 85%. We have a number of them in the field today. And so that's the real big advantage. You know, from our standpoint, of course, it's you know, we're focusing on getting the latest and greatest technology that, of course, is, you know, from an environmental standpoint, it's good stewards, as well as from a client perspective, we're saving them money on diesel costs. So it's huge dollars. I mean, if you're looking at it from a fleet perspective, you know, a tier 4 fleet can save about $10 million a year just on using you know, less diesel and using more natural gas. And that's of course, these, you know, the larger operators or more sophisticated operators that we work for, they will have natural gas basically back from their plant, because it needs to be processed. The gas needs to be processed from the wells, so they'll take it back from their plant that's conditioned back to the well site, and then of course it's plumbed into our equipment, and it's running. Like I said, the tier 4 engines themselves are running 84% or 85% substitution. So I see that being a huge advantage. You know, basically using you know, natural gas as a large substitute for the power. And it comes with a cost, though. I just want to preface that it's we had the option to stay with a tier 2 engine because you can grandfather that in with the asset base, and you can get a tier 2 engine for about $500,000, so $500,000. Or you can upgrade to a tier 4, which is currently today is just over $1 million. So it's really double the cost. And so you have to really look at it from a return on capital perspective on what really makes sense. And for us, it's as we've you know, signaled to the market, is we have no problem spending the money on bringing the latest equipment, but there's got to be some type of tied contract to it. And we're able to do that with NuVista here in Canada. They've been a huge you know, supporter of our business, and we're able to get a deal across the finish line where it was structured as a $26 million refurb program to get one fleet to tier 4 engines, and we structured it that they would give us a prepay of $10 million, and we work that off over the 3-year contract. So we like those types of structures because there's some skin in the game from the client's perspective. It gets our fleet upgraded, and yeah, I think you should expect to see that going forward on how we'd want to refurbish our fleet.
So the engine would cost $1 million, and the refurbishment for the entire fleet would cost $26 million. Is that how it works?
That's correct. Yeah.
Okay. So when they say tier 4 frac fleet, that's the $26 million price tag on it. And
yeah,
so sometimes
you want to hold on 2 seconds. I have this tombstone that I'll explain a little bit to you. If that, all right, hold on 2 seconds.
All right.
Can you see this right here?
I do. Yes, I can.
Okay. So here's a frac pump. Okay. So what we have here is the pump itself, right? And you have basically the transmission, the drive shaft, and here's the engine part of that pump. And so this is what we're replacing today. We have 16 of these going through a refurb cycle, and we're replacing this engine component, which costs about $1.1 million to replace this component right here. And what's good is you're allowed to use the asset that you currently have. And if you were to buy a new pump, you're about over $2 million. So it's really, call it 60% of the cost of new, and then you have basically a new asset in the field.
Okay, so that part is the million. Which one is the 26 million?
Well, so this part is the million, but then you're upgrading some of the components on here, and we're doing 16 of these. 16
okay,
pumps
yeah, I see
itself.
what you mean. Okay, so altogether it's a 16 million. Okay,
Yeah.
got it.
Yeah, so that about 16 of these are on site for the client.
Okay, got it. So so it's about a million to be able to convert to a tier 4 frac fleet.
That's right. Yeah.
Okay.
Yeah.
No,
just for the engine component, then of course there's some auxiliary assets or auxiliary capex that's required. Transmissions.
I think what I'm getting confused with, Steve, is because I know that there is you're also working on bringing a tier 4 frac fleet as well. It's one of them that was on your slide, and you mentioned 16. So is there maybe like there's a tier 4, maybe just engine, and then or I think I know. So the fleet is 16 units. Is that how it is?
That's right. Yeah. You got it. I'm gonna bring you out on a job site one day.
No, please do.
Yeah. You're gonna have to shave your beard though.
Yeah. Absolutely.
So so there's 16 of those on a job, right? So or more. Like in the US, we have 20 of them sometimes.
Steve, I was on a SAGD plant for the summer, the CNRL Peace River. So I've gotten a chance to hang out there, but I've never been on a fracking drilling site before. So this certainly would help kind of be a new experience and help build some context. So I look forward to that. So the other thing that we'll kind of move on to is maybe the consolidation of multiple service lines. Someone had mentioned this, and then another individual had sort of mentioned it's like, well, everybody wants to stick with what they're really good at because aside from that, what it can get really messy. But I just wanted to just throw that in as someone mentioned, how if you consolidate, they see all the different little components. What are the drawbacks of consolidating a lot of the different service lines in this business?
Yeah, I think like for us, we've been obviously focused on growing our business internally. So, we're very proud of what we do in the field on the coiled tubing side. So we've been consolidators of that space, and of course on the fracturing space. But if what we're really focusing on is kind of controlling our cost of our business by our last mile solutions. So logistics, getting that profit to location. But when we talk about a complete bundled service of wireline, pump down, we're very close to that already with our company, where we have pump down equipment, nitrogen equipment. So I think there's some aspects of it from a complete efficiency where you have control of that whole job site that makes sense for us. It's something that we've been looking at as we've looked at M&A opportunities. But as of today, I think we're happy with where we're playing today. We look at our US business. We've been able to grow scale on our coiled tubing side, where we're operating 12 coiled tubing units today in the US, and kind of starting, we operate in North Dakota, Colorado, and Texas. We like that because it's oilier, and we can add scale there a bit more on perhaps some M&A opportunity on the coiled tubing side. On the US frac side, that's something that we'd say that in Q1 we got kind of tripped up a little bit because we didn't have the scale that we needed. We had 2 operators that we were going to go work for had drilling rig delays, and when those drilling rig delays happen and you don't have any kind of spot work to go catch with these frac crews, then of course you're left with some white space on your calendar. And if we had double the size, like 6 or 7 frac crews in the US, then it wouldn't show up as much. And so that's something that our team has been looking at is is there some opportunity to grow into the US, add some assets there, and so it just has to be the right deal. Of course, when you're trading at 2 times it's hard to get a deal across the finish line because we're not willing to overpay when we're trading at such a discount.
Yeah, so good. And that kind of makes sense there, because if you have a drilling component, multiple different components, then you can take the entire contract, and then you say, okay, then we can take care of the logistics, and we don't allow someone else's delay to become ours.
That's exactly right. Yeah. Yeah.
No, that's really good. And I think the follow-up to transition to maybe talk about a debt target discussion, along with the return of shareholder capital. Another thing is we notice about 60% of the company is owned by ARC. In the thought process is, do we have any indications as to what's happening on that side? Do they plan to kind of hang out with us for the long haul? And if we don't know the answer to that, no problem, but we can just kind of talk about maybe debt targets, along with maybe the buybacks, dividends, and how you kind of see the combination all through, and in what order.
Yeah, just to remind everyone, we went into the downturn with call it 315 million of debt on our balance sheet. Currently today, we put guidance out, we're going to be between 130 and 133 at the end of Q1. So that's call it 180 million dollars of debt that we've repaid in what would be considered probably the most challenging times in our industry. So it's a good position to be at. We're call it 0.75 times debt to, our ratio there, debt to EBITDA. And we actually think a good debt level, Sohab, is around what our working capital is, because as a service provider, you can harvest your working capital to have to pay off debt if there's some type of major downturn. So our working capital today is between, call it 70 to 90 million dollars. So we're really there. We're really close to that from a debt perspective. We'll be at that at the end of 23. And so, it's exciting to be talking about what's next for us. And to me, that is, are we in a position to start looking at some type of a variable dividend in 2024? So, share buybacks for us probably don't make sense with the major shareholder like ARC that has 60%. And so our thought right now is we're going to continue to focus on debt repayment. I think that's the best shareholder return metric that we have in our pocket today. And as we look into 2024, we have obviously a relevant asset base that can generate great EBITDA, great returns. So we're going to continue to focus on what makes sense from a shareholder return perspective, and perhaps some type of variable dividend. And I mean, you did talk about ARC and our major shareholder. They've been so great to have as partners. Obviously they helped us get the story started. They've been kind of through the trenches with us in 2020, and they're extremely patient. And we traded at a 52-week high of $6.80, and they weren't prepared to do anything at that point. And so I think that's a signal, and they don't get us involved in any of their strategic decisions on what they do with their shares. And all I can tell you is they've been extremely supportive of our business, or they would have done something by now.
Sounds good. And I think the other thing that so STEP currently is at about a 21% free cash flow yield, better than some of the E&Ps right now. The effect of the higher prices, as the thought process is with some of the E&Ps are currently between 5 to 10%. You're looking at 21% for STEP. As then my colleagues on the E&P side would say, well, as we really torque and the commodity prices increases, then we're gonna get all of that back. So can we talk about for STEP, it's all based on day rates that are negotiated. My understanding is like I don't know how long in advance, but could you talk about, okay, if we see a run up in prices, maybe say $90, $100, how does that look like for an OFS company like STEP? Does it just kind of wait you know, quarters, 2 quarters, 3 quarters to kind of renegotiate? I'll pass it over to you to answer.
Yeah, I mean, we like to work with our clients, especially the key clients that we have. You know, I'll talk about New Vista, which we signed an agreement with. That's on a WTI scale, and so it's reviewed on a quarterly basis. So we have triggers in there. As WTI goes up, then we get a little bit more margin to our business, and I like that model because everything kind of focuses on WTI from a supply chain perspective, you name it. So, but when we're talking about, you know, kind of, you know, most of our types of agreements that we have are more pricing arrangements, and there's triggers in there that we have the ability to kind of renegotiate if we have some supply chain increases, of course, labor increases, those sorts of things are quite easy to pass on. When you talk about margin improvement, you know, I think what we talk to our clients about is, you know, this asset base. I'm talking in generalities, this particularly in Canada, it hasn't been renewed. Like there's just a lot of capital investment that's still required in this business. Technology, like when we talk to our clients in regards to technology, it usually comes from the OFS companies. Like they give us problems to solve. That's great about our industry is, hey, how are we going to pump 23 hours per day? Well, this is what we need, this, and so on. So as we look at the future, there needs to be more margin put into our business. There absolutely does. We've run extremely lean over the number of years, and I know most of the clients get that. They really do get that. It's hard to find labor, so we've had to increase labor rates. We've had to adjust work schedules. Typically it would be you work for 2 weeks and then you get a week off. Now they want more of a, you know, and I think it's really good because when you work for 2 weeks, you're up in a camp in northern Alberta. You're not close to your family, so it's a very demanding type of you know, kind of from a work perspective, and so we need to be able to pay for that. Our average age in our field is 39 years old, and so to get the Gen Zs out, you know, kind of into this industry, we need to be very competitive, number one, but we need to obviously be, you know, how are they going to grow a career in this industry? And I think the media has done a terrible job talking about this as a sunset industry. It's not a sunset industry. It is not. This industry is going to go on for decades to come, and I think we need petroleum engineers. We need you know, instrumentation techs. We need mechanics. We need you know, finance. You name it. I think it's something that we need to brag about more and more, about what Canada has done for the world, and what, from a technology standpoint, from basically producing the most economical barrel of oil out of the ground and keeping social matters in mind. You know, there's an election coming up in at the end of May in Alberta, and I hope people realize how important this is for the economy.
And so the other interesting thing, Steve, is STEP is a name that amongst the pressure pumpers, it's currently at one of the sort of the compressed valuations, but within the investment community, they've got one of the highest price targets. So what do you think is being missed, you know, between the two, between maybe the investors that are looking at these names, and what you think are maybe the analyst community is looking at, that allows them from amongst all the OFS to be most excited on STEP?
I really think we proved it in 2022 that this is a high torque business, and you know, our margins, when we look at our margins compared to our peers, it's top of class. When we look at return on capital, it stands out as best in class. You know, when we look at asset quality, you know, we've been able to reinvest capital, as I mentioned earlier, through the downturn to keep our asset base relevant. And the disconnect between the valuation to where our target is has a lot to do with, we have a major shareholder. I think there's people that maybe are, well, do I want to get into a stock that has a major shareholder? Well, I would say in this environment, we're on sale today, right? So they haven't proven that they want to sell any at this price, and even when we were at a 52-week high. So anyways, I think there's some I think some scarcity perhaps they'll have in getting into OFS. But I can tell you when you look at our clients' perspective, they got their balance sheets figured out. They're starting to pay a shareholder return. OFS is usually about a year to year and a half behind that. Our balance sheet's fixed. We're going to talk about a shareholder return. But I can tell you there's not going to be a rush out of expanding our company or building a whole bunch of new equipment that we load up our balance sheet to be able to capture some short-term EBITDA. It's going to be long-term opportunities, create strong partnerships for the future, and I think you're going to see that discipline out of us and many other competitors.
So I think this is interesting, Steve, because you kind of mentioned, yeah, there's maybe not an interest to go do something like that as opposed to maybe years prior, where there might have been kind of an instinctual response. All right, let's build, let's grow, let's do this. And you did talk that while currently the capacity isn't, as tight, if everyone, and I've talking to maybe other individuals that share the same sentiment, we're kind of want to maybe harvest some cash flows right now and enjoy the good times before we decide to grow. At some point, we could potentially run into a situation where the market gets really, really tight, and
Yes.
to the point where we start to see, I mean, even if we look at last year, and I think last year was an eye-opener for me because everything was fine, and the EMPs were saying everything was good, and then all of a sudden it was like service inflation was all the rage, right? And seeing how aggressively that came in last year, that's kind of a thing that I kind of put in back of mind where I'm like, listen, this could easily happen before you know it. So right now you're saying the capacity doesn't seem to be as much of an issue, but at $100, $90, $95, a bunch of programs are trying to be brought up online. I mean,
there could be a perfect storm that hits Sohab. And the perfect storm to me, just talking the Canadian market, we have LNG development that needs to be done. That's going to take up, call it 3 to 4 frac crews. We only have 20 in the basin that can focus on those types of operations. Then you have everything else. You have oil perhaps going to $90, and before you know it, there's not enough capacity in the market. And for us, we like to obviously focus on our clients that we currently have today. They've been good to us through the downturn. But we even saw it in Q1 where one of our competitors got overcommitted and basically left a smaller operator not getting their work done when they wanted to. So they were cold calling, service providers. We just happened to have a small gap in our schedule to be able to pick them up. And now they're saying, well, we're going to give you the rest of the work this year because of that. So I think that's really what the industry needs, is that tightness where it's like, okay, these service providers are very, very key to my success of my well being drilled and completed. In fact, we are what's the success. We are the blue collar worker of this industry, and without supporting that, you can have a 10,000 BOE per day company ran by 10 individuals and the rest are all subcontracted. Now, I'm not saying that's an easy business, because there's different things you got to worry about, but when you compare that to running a capital intensive frac pressure pumping business where you have 900 employees and you can't find labor, that's the big difference to me. And once that scarcity happens, then it could get a little fun.
No, it's I mean, that's where sort of maybe I've just kind of spent time, because when we look at the macro level, when we look at the physical barrels, as opposed to the current underlying price. We're like, okay, well, the physical is looking really, really tight. A lot of the data that's coming from some of the subscription services are showing much larger draws than is currently being captured. So you're thinking, okay, well, the physical is really, as we enter the second half, the Mike Rothman group from Cornerstone Analytics yesterday, they were mentioning that we're currently at 102 million barrels a day. Once that signals, I mean, you can really get a rip on the pricing point. And as we rip there, I'm thinking, okay, well, currently at this lower price, everything is kind of a little bit, there's a high level of demand. So you enter this type of scenario where you're thinking, well, this could really stretch out to the point where the EMP has got to start making appointments with you guys now.
Well, I don't want to be coming off being over cocky, but it is sort of
it's just me. It's
it's a wake-up call, I think, that this industry needs to understand, because they haven't had to deal with it since 2013 and 14. And at that time, you were booking frac crews 2 months, 3 months in advance. And my point made about, you can run a 10,000 BOE per day oil company with kind of a handful of people, but you could always pick the phone up and say, I need a drilling rig. Oh, I need a cement crew. I need a frac crew. When the frac crews or the drilling rigs companies say, hey, I'm not going to be able to get you one for 3 to 4 months. And by the way, here's a contract. That's where this industry needs to be more disciplined with that, because I can tell you today that a client can phone us up and say, hey, you're awarded this $6 million frac job, and then go ahead and order sand. There's no PO given to us. There's no deposit given to us. There's only the person's word of, hey, I'm going to use you. And you go ahead and order $3 million worth of sand, or whatever the well is, or the pad. And then a week before the job, he could say, oh, you know what? Somebody else came in a little bit cheaper than you. You can either match this price, or we're going to give it away. And there is not another industry in this world that I think operates the way we do, where it's a handshake deal. And you can't build a house today without 30% down before they even order the lumber. But we can go ahead and order a whole frac job with a text saying, hey, congratulations, you're awarded this job. So I find this there needs to be some discipline from the contractual side, and you're only going to get that when there's a scarcity of equipment and labor.
I guess as we wrap up here, as we reach the top of the hour, it was just a great discussion. I've learned immensely from you, Steve, and I really enjoy these so much, because you're always picking up some new ways, and what other way to do it. Just learn alongside your audience that are going to be watching this, especially with the OFS space, totally foreign to me. Just kind of been really intrigued by it, a lot of it, thanks to your favorite individual that getting the word out, getting the OFS word out there. I guess maybe the last thing is, I just noticed that steps amongst the highest in the OFS space on return on equity. It was just one of your charts. I just maybe ask you, why is that, and kind of wrap it up. I'll wrap it up with maybe like visions for steps moving forward. So if we can maybe talk about that, you kind of really stuck out there. And I think by asking these questions, people kind of get a good understanding as to maybe what you guys do differently on that front.
Yeah, I think it's all based on a trailing 12-month kind of average. And we were, from a share price standpoint, we were trading at a kind of at $1.50 this time last year, or $2. So, I mean, we ramped up to, kind of 680, as I mentioned before. That has a lot to do with just the torque that we have in our business. We absolutely look at every cost that goes in this business. We continue to focus on that, because I think that's really what drives our margin. And the second thing, probably the most important thing, Swab, is just we track every hour of performance within our company. We have extremely high KPIs that we've set, and so that helps drive high execution on location, and that is really what this company was built on, is exceeding our clients' expectation, basically using flawless execution on getting that done. So our kudos goes out to our team of professionals in the field that operate this equipment, and they have pride in doing that.
And the torquiness is attributed to the debt. It's attributed to also the efficiency that you guys. So just a mixture of two that allows you to be amongst the torquiest OFS.
And high utilization. And utilization really drives margin in our business.
Got it. So to wrap it up and bring it all together, Steve, maybe closing comments, just vision for the future for STEP, maybe the next, nothing to hold you to, but just give the viewers an idea of how you see things moving forward for STEP. Yeah,
I think we're in inning 2 right now of this cycle, and I really believe, or we believe in this organization, that there's 2022 was a good year. 2023 is going to be flat. I think 2023 is going to be very similar to our last year's performance. But as we look into 2024, 2025, I think that's where things get really exciting from an LNG offtake perspective, from a lack of equipment that's available, lack of labor. I didn't talk about, if I ordered a frac crew today, we're 18 months out. So even if I were to get a contract today, to get it built, it's 18 months. To get it staffed, it's probably 6 months. So those are really key metrics as we look into the future. And so, I think working with our clients to establish higher utilization during slower periods will end up generating better margins, and for us, controlling our costs with supply chain, with using our last mile logistics team, it just sets up for a very exciting future for the company.
And just a quick follow-up question. So you said the 18 months 18 months out for a frac crew. This is the people along with pulling the equipment and refurbishing it and getting it ready, right? Just those two things that are going to take that time.
Yeah, I mean, you can get the people as the equipment's being built. Sorry, I think our lights are shutting off.
No worries, it's all right. We're winding down anyways. I'm having the same thing on my end too.
I think what I can clarify is, to get an engine today, just an engine for a frac pump, is 12 months. So if I were to put a PO down today, it's 12 months to get an engine. To get that whole unit built is about 18 months. So in conjunction with that, you can staff, but it's going to take you probably 5 to 6 months to staff for that new frac crew. And I think that needs to be publicized on you just can't snap your fingers and get a frac crew into the field. It's going to take a year to year and a half at a minimum to get things in the field working. So
no, that's great. You can't even grow even if you wanted to.
That's exactly right. No, you can't. This industry, it is tapped right now. So, it's I think our clients understand that. So it's just working with them on making sure they're efficient, and in return makes us efficient, and so we can go to the next well, to the next client.
Steve, it was an absolute pleasure having you here for our 3rd episode of the podcast. We've got a lot of other interesting guests coming up in the following weeks, and we hope to see you. It was great seeing you at the last best meetup, and hopefully we can see you at future meetups.
I really enjoyed that, Sohab, and I'll definitely invite you out to our next field trip into the field, so you can see some pressure pumping equipment working.
I'm looking forward to it. All the best. Take care.
All right, take care now.